Good afternoon, everyone. My name is Todd Salamone. I'm the Senior Vice President of Research at Schaeffers Investment Research in Cincinnati, Ohio. At Schaeffers, we provide real-time option recommendations to retail investors like yourself, and we also provide options education. Some of you may know Bernie Schaeffer, who founded the firm in 1981. So we've been in business for nearly 40 years providing option recommendations and education to thousands and thousands of subscribers over the years. Today, I am here to discuss option buying tactics from our Elite Trader program. Now, I realize some of you are option sellers. I also realize some of you have not dabbled in options at all. Hopefully, by the end of this presentation, I will convince some of you stock traders to become option traders, and hopefully those of you that are geared more toward option selling will also consider option buying among the tools that you provide yourself in order to enhance your return. Specifically, I am going to be talking about our Elite Trader option program. This is one of our best option trading services. For example, over the past 2 years, this program has delivered 463 trades to our subscriber base. The cumulative returns from these trades is 5,878%. How do we calculate cumulative return? We add up all the profits from the winning trades, and then we subtract out the losses from the losing trades. The net return is therefore the cumulative return. The average winning trade of our profitable trades is 110%. The average losing trade is minus 51%. And the win rate is 40%. And I will go on to explain why this win rate is 40%, which may seem low to some of you, especially premium sellers. But basically, when you let your profits run and cut your losses short, you can have a win rate of less than 50%. This service provides simple call buying and put buying recommendations. So again, if you're new to options, you don't have to worry about spread trades or trades that come with certain margin requirements. It's very simple call and put buying. We are targeting profits of 100 to 200% depending on how risky the option is. It is a mix of put and call trades. We recommend a put option when we expect a stock to move lower. We recommend a call option when we expect a stock to move higher. Some trades are based off events. Some are shorter term options with expirations from about 3 weeks to a month, while other are longer term option trades with expirations up to 3, 4, even 6 months. It is real-time entry and closeout instructions, and they are delivered via email and or text during trading hours. So let me begin by first discussing what our goals for today are. First, why buy options? And that will be, again, critical to those of you that are premium sellers and or stock traders looking to make that move into option buying. Then I will discuss specifically some of the option buying strategies in this Elite Trader option buying program. I will go over some money management concepts that are critical in order to achieve bottom line profitability. And then I will discuss some common mistakes that I have made over the past several years, having been with Schaeffers over 25 years, and common mistakes that I see everyday option buyers make. And that includes when I'm here at a money show, as I'm here in Las Vegas, when I am just talking to subscribers and or would-be subscribers like yourselves. First, let's discuss a reality among option buyers. That is, when you are buying options, you are buying time. The further until expiration, the more time that you're buying. The more volatile a stock is anticipated to be, the more time that you're buying. So one risk to the option buyer is the time decay. And as you can see in this graph, note that when you're buying an at-the-money option, that means the strike price that you're buying is about the same as the current stock price. Note how that there is time decay that occurs. Time decay is nonlinear, again, as you can see in this graph. So if you're buying an at-the-money option, at first the time decay occurs slowly, as you can see on the left-hand side of this graph. But notice as you move closer to expiration, which would be the right side of the graph, notice how that time decay accelerates. And that is one of the reasons your win rate will be lower when you're buying options. Time decay is an enemy of the option buyer. It is an ally of the option seller. It is an enemy, so that is one thing that you're up against. That said, even though you have some enemies, that being time decay, a lot of people new to options view option buying then is a huge risk. But I'm here to tell you option buying can actually reduce risk. How so? Well, one, that depends how you're using options. Some use it as a hedging vehicle. In other words, if one is looking to protect a certain stock or a portfolio, he can use options to reduce risk. He can do that by buying a put option and lock in a minimum selling price. Or, as we do in this elite option trader program, one can buy options as a speculative tool. Now, how is that? How can you reduce risk when you're speculating? Well, one, and this is relative to a stock trader, when you're using options, you can put significantly less dollars at risk relative to trading the stock. And why can you do that? Well, that comes to point number 2, the leverage. In other words, the returns on the option can be a multiple of the stock return. So whether you're buying a call or a put, let's say the underlying moves up 10%, you might achieve a 100% return on the option. Or if you bought a put and the underlying stock moves down 10%, you might again achieve a 100% return on the option. And point number 3 is you can make money in up or down markets. Now, how is that reducing risk? Well, what I'm referring to especially there is making money in down markets. So one of you may raise your hand and say, well, Todd, I can make money doing stocks in a down market by shorting the stock. And I will say, yes, you are absolutely right. But when you short a stock, in theory, you have unlimited risk. However, when you're buying a put option on the bet that a stock will move lower, your risk is limited to the premium paid. Now, let me take you real quick through that example of buying a stock versus buying an option. Let's assume stock XYZ is trading at 107. Now, if I'm a stock buyer, I could buy 100 shares of that stock and it will cost me $10,700. And let me stop myself right there. Some of you might say, yes, I don't have to buy 100 shares. I could buy one, and that will cost me $107. And I will say again, you are absolutely right. But think about your profit potential if you're only buying one share of stock. So in this example, I'm assuming 100 shares of stock so that the stock buyer can achieve a decent profit. Now, the option buyer might buy a short-term 100 strike in the money option, and that option has a premium of 9. Now, since each option contract represents 100 shares of stock, I'm going to multiply that 9 by 100, and that will cost the option buyer for one contract $900. So in that first row, you can already see a difference. Less dollars at risk when you buy the option versus buying the stock. Now, let's go through a few scenarios. Scenario 1, at expiration, stock XYZ is unchanged. So that means if you're a stock buyer and you decide to sell that stock for whatever reason on option expiration, you sell it at $10,700. In other words, a break even on the trade. Now, I'm not considering commissions, just for ease of explaining with this example. Now, the option buyer lost $200. And he basically what he lost was the time premium that he paid. Notice when he bought the option, the stock was at 107, and he had when he bought that 100 strike option, he basically bought the right to purchase the shares at $100. So with the stock at 107, when he did this transaction, he's going to pay at least $7 for that option, because it's already 7 points in the money. But remember that time decay graph that I showed you at the beginning. He also paid $2 of time premium. And by expiration, that $2 evaporated. And because there was no more time to expiration, there was no more time value in the option. So he lost that $2 time value, which is $200, or 22%. Which again, on a $900 investment looks pretty high. It's a 22% loss. But a $200 loss if he had invested $10,700 is not a lot of money. Now, let's say the underlying stock rallies up to 120 at expiration. The stock buyer realizes a $1,300 profit, or 12%, because the stock rallied 12%. Now, check out the option buyer who only put $900 at risk. That option at expiration is now worth $20. 120 minus the strike price of 100. He sells it for 20, and remember, he only purchased it for 9. That's a 122% profit. That's in other words, a $1,100 profit. Now, again, you may come back to me, well, Todd, had he bought the stock, he would have had a $1,300 profit, $200 more. And again, I'm going to come back to you and say, yes, but he only put $900 at risk in order to book that $1,100, whereas the stock buyer put $10,700 at risk, almost $10,000 at more, and in order to realize a $1,300 profit. So that's where I would argue there is less risk in the option buying relative to the stock buying. Now, let's say XYZ goes against the option buyer and the stock trader and drops to 105 at expiration. Okay, the stock buyer lost $200, which is a 2% loss. The option buyer experienced this quote-unquote enormous 44% loss, and that looks huge, but note it's only a $400 loss on that $900 investment. So again, On a percentage basis, I think some people hear about these huge losses that an option buyer might take, but in the grand scheme of things, when looking at it on a dollar basis relative to the stock trader, it's not all that much money. So let's move into option selection. I'll admit, if you're new to options, or even if you've been trading options for years, options are just that. There are a plethora of options once you decide on a stock that you want to buy an option on. There are different expiration dates. There are different strike prices. And that can be quite intimidating and admittedly quite confusing. And again, we've been doing this for nearly 40 years. And there is a method to the madness, if you will, in terms of selecting an expiration date and in terms of selecting a strike price. And one advantage that a subscriber has to this Elite Option Trader program is we do all the work for you. We use our experience, we use our knowledge, we use our tools in order to decide on the best expiration date for the play that we're going to give you, and to decide the best strike price for the trade that we're going to give you. So for example, when we select an expiration date, that is going to be dependent on a few factors. One is what kind of sentiment and technical drivers are we using? At Schaeffer's Investment and Research, we do a lot in sentiment analysis, and we have different sentiment tools that we're using. And we use sentiment in a contrary manner. In other words, when we see a stock moving higher and we see evidence that people do not like this stock, we will use that setup to buy calls and bet that the stock will move higher, because we see evidence that there is maybe short covering potential in the stock, or maybe we see room for upgrades, or maybe we see some potential unwinding in the options market that could spark a short-term move in the stock. So we use a combination of sentiment and technical drivers for our trades. And depending on those drivers, that's going to determine the expiration. Also, we may look and notice whether or not there's a calendar event, such as earnings or an analyst meeting coming out. So if we see a near-term catalyst, we may shorten our time that we play till expiration. However, vice versa, if we don't see a particular catalyst, such as the calendar event, we may lengthen the time that we play until expiration. And we're also looking at the implied volatility term structure. In other words, the implied volatility, which again, let's go back to what I was saying before, the higher the implied volatility or expected movement in the stock over a defined period, the more time premium you pay. And if you look at the implied volatility of the options over the various expiration dates on an underlying stock, you will sometimes see that the implied volatilities are different. And we will look at that term, that's called term structure. And we are looking as option buyers, obviously, to buy the cheapest options as defined by implied volatility. Strike price selection, that's going to be dependent first on risk tolerance, and that's up to you. The riskier an option is, the closer to the money that option is. In other words, out of the money, at the money options are riskier than in the money options because they're made up of entirely time value. And think back to that chart I showed you, that time value erodes over time. So if you're buying 100% time value, and that's susceptible to this time decay, you better be targeting higher returns. And with those higher returns comes increased chances of a total loss on that option. So risk tolerance. Also, whether the implied volatility is high or low. If implied volatility on an option is high, we may move deeper in the money in order to take the sting, if you will, out of that time decay. So about 40% of the trades subscribers receive in this elite option trader program are what we in our world are longer term options. Again, this is our world, which would be 3 to 6 month options. In other words, if it's say May, we might be looking at a June, July, August through October type expiration. Some of the things that we're considering is what type of sentiment unwind there is. And again, one factor that we look at are analyst ratings when we're evaluating a stock. And if we see a setup where there are a lot of hold and sell ratings relative to buy, and we like a stock, we might be anticipating upgrades, but those upgrades may not come tomorrow or next week or necessarily within the next month. If they do, great. But if they don't, we've got time. So we'll go out and play a 3-month to a 6-month option to allow that particular sentiment unwind to occur. Sometimes, from a technical perspective, we like the longer term trend. However, we see on a graph that there's some short-term resistance on a call play. Or if we're looking at a put where the long-term direction of the stock is heading lower, but we see that there could be some support that comes into play over the next week or two, we will again go out in time. Now, we're doing that because this resistance or support could break down tomorrow or next week, but if it doesn't, we're not going to stress over that. And because we've got that 3 or 6 months for that support or resistance to finally give, and it's at that point we think the stock's going to make a huge move, which is what we want when we're option buying. We will generally play a 3 to 6 month option when implied volatility is low. Now again, I'll repeat. Remember what I said at the beginning of the presentation, that time decay. If the implied volatility is high, that means that you're buying more time, or there's more time premium embedded in that option. And that time premium erodes over time. So as an option buyer, if I'm buying more time, that means the premium, when the implied volatility is high, I'm buying more and more time premium. And that will work against me in terms of the leverage I can get if I'm correct, or the amount of time decay that occurs if the stock doesn't move. So I'm generally focused on low implied volatility options when I buy a lot of time, just because now if it's low implied volatility, that means less time premium, that means less time decay. I'm also going to go out in time when there's an absence of a recent or upcoming event. In other words, there's the chart looks good, the sentiment backdrop looks good, but there's not an immediate catalyst. Makes sense to buy time. Or if I'm buying a breakout to a new high, or I'm buying a breakdown to a new low, again, I'm going to buy time. Why is that? For some of you that are technicians in here, some of you know that some breakouts just continue and never look back. Other times there might be a retest. So I'm going to buy time in case the latter scenario occurs where there is a retest of that level before the trend continues. I'm always looking to target a 100% profit when I'm buying these 3-6 month options. And that's how I'm going to determine a lot of times the strike price. I want to be in the money a little bit when I buy those options, but I always have a target on the stock that I think it can get to. And if that option cannot deliver a 100% return by the time it reaches that target, then I won't do the trade. So one of the things that we have at Schaeffers that I think gives us an edge, and therefore our subscribers an edge, are unique screening tools. And I'm going to show you all a couple today. And keep in mind, this is only a couple. We have several traders on site every day. We have quantified, quantitative analysts who sit right next to us, and the traders and the quantitative analysts are always working together to develop new screens, to improve current screens. And we get about 20 to 30 screens each day. Not every trader necessarily looks at every screen. They have their own screens that they prefer. But what's great for you all is you're getting maximum coverage from our traders looking through these screens that we think no one else or very few people have access to. That is what's called an edge. So this is one tool that I personally prefer. It is looking for or universe of options, looking for stocks that are at or near a 52-week high, but the options are very cheap relative to how they were priced over the past year. And it's looking specifically at the implied volatility of those options. Not only is it giving us data on stocks that are with such a setup, but this screen also tells us how that stock has behaved over the next month when a setup like that occurred in the past. And as you noticed, I highlighted one such stock that appeared on this screen back in mid-March, Cree Research, a semiconductor company. It gives us all the relative data, SVI, percent rank, that's our Schaeffers volatility index, which is the implied volatility of the stock and how that ranks relative to the past 52 weeks. It gives us a volatility scorecard, which is one way we have measured how option buyers have fared buying options on this stock in the past. That's a tool that we have that is unique to us that I don't think anybody in this room would have access to. And again, it tells us when this stock's been at or near a 52-week high in the past, and the implied volatilities on its options were relatively low. How did it perform? So this is what our subscribers received, and I'm going to take you through what other drivers were there when we did this trade. On March 18th, our elite option buyers got an email in their inbox that read as follows: place a daily limit order to buy to open the Cree June 21st, 2019 55 strike call at a maximum entry price of $5.50. We give them an entry window to get in, and we tell them where the option currently is, bid and offered, and where the stock price is. Now, what were our drivers? Here at Schaeffers, we have a rule, and that is when a trade is made to our subscriber base, we let all the traders know exactly why we did this trade. In other words, we let the traders in-house know what our edge was. And we have a rule. There has to be at least two things about this stock that no one or very few people know. What I did is I highlighted what would fall under that camp of what few or no one else knows. First, our internal volatility scorecard, which rates how option buyers have done in general when they buy options on Cree. And that rated pretty high on a scale of 0 to 100, a 77. The shares were up 33% year to date. Now, again, everybody probably knows that. That's not unique. I did highlight 52-week high. Now, again, that's something a lot of people probably knew, but they probably did not know what the quantified results were when this stock was at a 52-week high and the option implied volatilities were very low, which was the next bullet. And that's why I highlighted those bullets. There was something I knew about the combination of the price action, in other words, the 52-week high, and the options backdrop in terms of options being cheap when the stock is at a 52-week high, in terms of how that stock performed historically. That's something I knew that I got a feeling a lot of other people didn't know. That's an edge. I'll show you this on the following slide, the breakout and the retest of a previous resistance level. I don't consider that unique to us or unique to a lot of people, so I didn't highlight that. I don't think a lot of people were aware of the low analyst ratings. Again, a stock's up 33% year to date. I think the assumption is, well, Wall Street must like it. There must be a lot of buy ratings. No, wrong. You look at that stock, even though it was up 33%, there were, of the 10 analysts that follow the stock, only 4 buy ratings. 5 holds, 1 sell. That's telling me upgrade potential. Now, short interest on the stock, again, this is where we're drawing that contrarian flavor in. Short interest was huge, 10% of the float. Again, I don't think that's unique. I think everybody has access to that information. But what intrigued me in this highlight was not only am I looking at the absolute level of short interest, which I think a lot of people look at, but there was also a lot of covering activity since October. In other words, the shorts were in covering mode. That's something I like to see on a strong stock. I know that the shorts are getting pinched. I know the shorts are losing money. I know they're panicking, and that can be a tailwind for a call buyer anticipating a stock to move higher. So here is the what I was looking at what we were looking at when we issued this trade to our elite option trader subscriber base. The green arrow is when we issued that recommendation. So note how the stock had just broken out above the 51, 52 area, which had been resistance back in 18 and earlier in the year in January and February. It had broken out and then early in March retested that level and then moved to a 52-week high, and that's when it appeared on that screen that I'm talking about. Now notice that circle. Not only do we tell you when to get in, we hold your hand and tell you when to exit an option trade if you so choose. And that's when we deliver these closeout instructions. Place a day limit order to sell to close 50% of your position in the Cray June 21st 55 strike call at 11 or better. Now again, notice I only told them to sell 50% of that. So if they had bought 4 contracts, they are to sell 2. That is what's called a free trade rule. Now you're playing with house money because the profit the elite subscribers were taking was roughly just over 100%. So now you're playing with house money because no matter what happens to that stock between now and expiration, the worst the subscriber can do is a break even on the trade. But I instructed them to leave the trade open because conceivably that stock could move higher, and it had time to do so because it was only April 12th. This was a June expiration option. And if Cray moved higher for another 2 months, that's where you get some significant profits on the trade. Now let's move into another strategy that we deliver, and that is short-term at-the-money option buying. This is what I would call aggressive option buying. We're targeting bigger gains, 200%. But what you have to realize is these types of options are also most vulnerable to what's called crapping out. In other words, you could lose 100% of your investment. And this is why we really advise traders to elite programs to identify these options as aggressive and put less money in those trades than you do in the longer term option trades or in the money short term option trades. If you see a short term at the money option, put less money in because it has higher profit potential, but also it has more percentage. It has more potential to totally crap out. Now, first, should you be doing these trades? Yes, if you have a very aggressive mindset. You're one that's willing to risk $400, $600, $1,000 and lose that entire investment. But you're also looking for huge profits that if you put $1,000, you're expecting at least $3,000 in return. If you don't have that type of mindset, you would ignore these trades. We do these type trades when the quantified technical or sentiment data supports an immediate move. Notice how I said immediate. That doesn't mean we have time to sit around for a couple weeks or a couple months and let this trade play out. It's a philosophy we have at Schaeffers called FAR, which stands for the move has to be fast. It has to be aggressive. Aggressive means a big move because you're buying all time premium, and you have to. The move has to be big enough to overcome that time premium, and it has to be in the right direction, of course. One indicator that we're using in these type of option trades is open interest on a stock. In other words, what we're looking at is the options open interest configuration. Is there a lot of put open interest on a stock that's moving higher? Or is there a lot of call open interest on a stock that's moving lower? Why does that intrigue us? Well, we know that if those call options on a weak stock were bought to open, and what we do is we purchase data from various exchanges in order to tell if that open interest was bought to open, and we know that whoever sold those calls, the market maker, for example, we know they tend to hedge. And if they sell a call, they will hedge by buying stock. Now, if those calls are about to expire, we know the market makers are going to take that hedge off, and they will turn around and sell the stock as expiration nears, especially when the open interest is out of the money. So we will use that as one of our tools to gauge, hey, there could be some unwinding related to expiration that results in market makers liquidating their long inventory in this stock. And we know when expiration is, we know that unwinding is going to happen, so that might be a short-term option play. The fourth bullet is if we see a catalyst on the horizon. Maybe it's earnings. Maybe it's an analyst meeting. Maybe there's some industry event coming out where we think there could be news that this company delivers that is good or bad. So if we see a catalyst in the near term, we may choose a near-term option. Maybe that expires a month or 6 weeks from now. We are looking for cheap options, again, because we know that the accelerated time decay is going to occur quicker. In other words, when this time erosion accelerates, it might be a week or 2 weeks from now, depending on if we buy a 2-week option or a 6-week option. So we're looking for cheap options relative to the 52-week implied volatility range or relative to the historical volatility of the stock. And I can't emphasize this enough. When you're buying an aggressive option, short-term, at the money, made up of 100% time value or nearly 100% time value, we are targeting 200%. And if you can't stay in it for 200%, we would not advise that you buy that type option. Another thing we do at Schaeffers is pre-event trading. Admittedly, a very difficult thing to do, especially when it's earnings, because when earnings are coming out, everyone knows the stock might make a bigger move than normal, and therefore they're going to make you pay a higher price for the option. And by the way, you got to get the direction right on top of that. So let me just give you an example of what type of option play we may do when doing pre-event trades. And again, this comes back to that implied volatility structure, and you got to be very careful. This is an example of a stock that recently came out with earnings. It was Electronic Arts. And I was looking, Electronic Arts was coming out with earnings on May 7th. So what I did was I looked at the implied volatility of options that expire on May 10th, May 17th, and June 14th. Now, what would make sense on the surface is to buy, with the earnings coming out on May 7th, it would be to buy the option that expires on closest to earnings day, which would be May 10th. And by the way, that is the cheapest on a dollar basis, as you can see by the ask price. So if I'm looking with Electronic Arts at 91.50, I evaluated all the at-the-money strikes, and they happen to have $91.50 strike prices. So the knee-jerk reaction is buy the cheap option. And I say cheap, and I would put that in quotes, because it is cheaper on a dollar basis. But look at the implied volatility on the options as you move, as the expiration date is closer to earnings day. The implied volatility was 111%. That means basically that the time value you are paying per day until expiration is huge relative to the implied volatility of the May 17th, which was 72%, and the June 14th, which is 48%. In order to put this in perspective for you all, what I did is I calculated, I took the ask price of the option, and I divided that by the number of days until expiration to calculate what you are paying in time value alone per day. Notice on the May 10th option, you're basically paying just for time $1.04 per day. And remember, as you move closer to expiration, there's that time decay that's going on, that's moving in a nonlinear rate, and that's going to accelerate just days from now. And not only is that true, but the implied volatility is going to drop after earnings because uncertainty becomes certainty. And now that the earnings is out, implied volatility is going to drop. So the option buyer buying pre-earnings is going to take an implied volatility hit too. The May 17th option, you're only paying 49 cents per day per unit of time. And on the June 14th, you're only paying 22 cents. I'm taking that $5.85, which is more expensive on a dollar basis, but on a daily basis, that option's only losing 22 cents a day, not $1 a day, like the May 10th option. So what basically we're looking at is sometimes if you get an event-based trade, even though it might make sense to buy an expiration that's closest to the event, you may see in this service anyway options that might expire a month from now, even though the earnings could be the next day. And this is simply because we want to take that time decay factor that's an enemy of the option buyer. We want to remove that factor as much as we can. And remember what I was telling you before about Electronic Arts. You have your pre-earnings implied volatilities, and then you got your post-earnings. So what I did is I captured the changes in implied volatility. And this graph, by the way, is courtesy of Trade Alert, which is a subscription we have that does a lot of work in options data Very good company. We've been subscribing to that software for several years now and make a lot of use out of it. But look at the May 17th option, for example. The implied volatility change, or the time value embedded in that option, dropped a lot post-earnings. The implied volatility had a 23 percentage point change from pre-earnings to post-earnings, and that was only in one day. Now, and by the way, those aggressive options represent another about 40% of the trades delivered in the elite package. Finally, another option buying tactic that we have is short-term in-the-money options, which is different from short-term at-the-money. What you're doing is you're moving deeper in the money, which is going to make the option more expensive, but it's also going to take some of that time value out of the option. And basically what we're doing with these short-term in the monies is the time value, whereas for an at-the-money option may be 100% of the option price, with these options it may only be 20 to 30% of the option price, which means if there's time decay, it's not going to impact the overall option price as much. And this is a great strategy, especially for those of you looking to transition from stock trading to option trading, because these options from the start are going to behave more like the stock. We like using short-term in-the-money options when we're trading high-priced stocks. And all things are relative, and I'm going to get to that. In other words, if you're looking at a $100 or $200 stock, like the example I showed before, if you buy the stock, that might cost you $10,000. But if you use an in-the-money option, you can control 100 shares of that stock for significantly less money, even though the price of the option might not be what you're expecting when you're trading options. And I'll get to that example. Now, when you're trading these type options, lower odds of a total loss. So you can put a little more money in these trades, and you will, because the option prices are generally higher. And like I said before, the option behaves more like the underlying equity. In other words, when you first trade an at-the-money option and the stock moves $1 in your favor, the option may only move 40 or 50 cents. But when you're trading an in-the-money option and the stock moves $1 in your favor, the option might move 80, 90, 70 cents. So again, it's behaving more like the equity. Time decay, as I just said, is less of a factor versus an at-the-money or out-of-the-money option. OTM means out of the money if you're looking at this slide. Underlying options are expensive relative to the 52-week implied volatility range or the historical volatility. Again, if we see an expensive option, we might move deeper into money because an expensive option means more time value, and remember that time value decays over time. So how do we take that enemy out? We go deeper in the money, and therefore the time value is less of a percentage of the overall option premium. And again, if we see an absence of a recent or an expected upcoming event, that means there is a chance the stock may not move. And if the stock doesn't move, again, you got that time decay working against you, and that's less of a factor in an in-the-money option play relative to an at-the-money or out-of-the-money option play. So here's another screen, and I'm going to give an example of a trade we recently did. This is recent IPOs relative to their IPO price, and we basically have a screen that looks at stocks that have recently IPO'd over the past, say, 5 years. And what I've noticed is that a lot of times these stocks will stall at a multiple of the IPO price. For example, once it gets double its IPO price, it may sell off. or it may consolidate right around that price. It may get a little above and a little below, but it just kind of trades in a range in that area. Why is that? It makes perfect sense. Think of an IPO. You may have all those institutional investors, the big money, the deep-pocketed buyers, the informed traders that had access to that IPO and got it at its IPO of, let's say it was at 20. And once it gets to 40, they're probably, it's a game. Trading is a game. You got to think like others. Once it gets to 40, they're likely taking a little bit off the table, aren't they? And that's why you might see that stock stall. So this stock came up on this screen of ours. I noticed it was Shopify. It was trading at basically 11 times its IPO price. So the return, or actually 12 times its IPO price. The return, as you see in the highlight in the far right-hand corner of the table, was 1,080%. That means it was trading just under 1,100% profit, or 12 times the IPO. And Shopify was a stock that I was noticing on the charts was really respecting those multiple levels, 100%, 200%, 1,000%, 500%. Whenever it would get that type of profit at the IPO, it would tend to stall. It was also on another one of my favorite screens, which I showed you before, the 52-week high and cheap option screen. So here's a stock, strong price action. We know it's stalling because we know there's probably some institutional money taking some money off the table. But it's a very strong stock, cheap options. Our option data suggests a big move was coming over the next month. Whenever the options were priced cheaply, a big move tended to occur and it tended to be higher. So we did again, and this would fall under a high price stock. Our quantified data said 1 month, high price stock, volatile stock, ripe for an in-the-money option play. So we told our subscribers via email and or text, place a day limit order to buy to open the Shopify April 18th 190 strike call at a maximum entry price of $13.40. Now again, we issued this trade on April 4th. $13.40, that's $1,340. To some of you that are considering option buying, man, that's not for me. I thought you could buy options for 50 cents a dollar. Yes, that's true. But again, all things are relative. The stock buyer, if he were to buy the 100 shares of this stock when we issued this recommendation, the stock was at $199.14. It would have cost nearly $20,000 to control 100 shares. So that $1,340 looks puny relative to $20,000, doesn't it? What were the drivers here? Again, we're looking for at least two things that we know about Shopify that others don't. One, the 40-day moving average was support historically, and that was also in the round 200 area. Round numbers tend to be very supportive for whatever reason. Call it psychological resistance support. This was a tell that we got. Citron, which is a noted short selling company, had just come out that morning when this trade was issued and issued a $100 price target. Now, that was news to everybody, but what did we know about that news that maybe most people didn't know? Citron had been bearish on this stock for over a year, with at least 5 separate notes talking about caution. And what we have been noting was this stock was shaking the news off more and more. And that was why I put a tell. If you have a noted short seller that's followed by a lot of people and the stock is barely reacting to extremely bearish news, that's telling me there's some underlying strength. The third bullet highlighted, 204 was a recent resistance. Again, that's 12 times the IPO. the stock was in an uptrend, but we understood why it was struggling in recent days. And I should say struggle in quotes because it was simply consolidating at near highs. We understood why that was happening. Now, what else did we know? Big out-of-the-money April put open interest. Let's go back to what I was describing before. If we see those out-of-the-money puts, and we know those puts were bought to open, and we know they're about to expire within the next 2 weeks, we know the market makers that sold those puts were short the stock. And we know since those puts are about to expire, the market maker is going to cover that short because he no longer needs that as a hedge. So we know there's going to be some short covering that could be a tailwind in the next couple weeks. The shorts were 7% of the float. So here's a stock trading at or near a 52-week high, an all-time high, I'll add. Yet it was heavily shorted. But the shorts, we looked at the direction of short interest, noted they're in covering mode. Again, a tailwind. And as I was saying before, whenever this stock's been trading at or near a high and the options are priced extremely low, it has tended to perform very strong. So again, here's what you'll see on this chart. The 40-day moving average, and it was pulling back. The green arrow is our entry point. That's when Citron issued the bearish note. Yes, it sold off, but again, if you look at this stock in the grand scheme, not a huge sell-off. 40-day moving average was there that could provide support. It's an unusual moving average, I know, but sometimes stocks respect that, not the more popular 50-day. The solid horizontal line is the round 200 level. Again, stocks tend to, and as you can see on Shopify, tending to find support at that round area over the previous month. The 204 level is the horizontal line with the dots. Again, you had a stock near a high and it was struggling that area. We think we understood why. Probably some big institutional money realized they've got a huge profit. It's exactly 12 times the IPO, probably piecing off some of their long positions. But we're also thinking, we know there's going to be short covering related to the puts. We know historically when the options are cheap, there tends to be an explosive move in the stock. If this thing gets above this resistance level that everybody can see in a chart, it could be the ensuing move could be explosive. And that's exactly what happened. It was just within a week, the stock started moving in our favor. In that circle, you can see where we issued these closeout instructions on April 18th. Place a day limit order to sell to close. This was the final 50% of the position in the Shopify 190 strike call at 29.70 or better. Now again, that 29.70 looks pretty expensive relative to the $1,300 roughly they bought the option for. They more than doubled their option on that trade. The profit was well above 100% when they closed the second half of this position. So let's move on. I gave you some of the tactics, some of the strategies we do in a late option buyer. What are some basic money management concepts one can employ? Low win rates. You will have a low win rate. Why is that? One, unlike a stock buyer, you have to be right over a defined period. That's the expiration date. Number two, you have that time decay working against you. That's going to contribute to a low win rate. And you have to be cutting losses. And sometimes it can be a small move against you where you have to just get out because you know because you have a low win rate due to a finite period where you have to be right, due to the time decay, you have to go out and cut losses so your average win is much higher than your average loss. Low win rates, though, contribute to a high probability of consecutive losses. I will get to that later. You got to combine high target profits with an aim to cut losses. Again, Not a trade goes out this door unless we see profit potential of at least 100% and or 200% or more. You have to allocate more money to the in-the-money options than at-the-money options. In-the-money options have a different risk-reward profile. Lower average loss, lower average win. So you allocate more money to those trades. At-the-money options, you're targeting 200%, but you can also lose 100%. So allocate less money, because when you get those 200% profits, it's going to give you a huge dollar return. At the money options, you got time decay working against you, so we tend to utilize time stops. Within the money options, where the stock behaves more like the stock, or the option behaves more like the stock, we're targeting 100%, but we're also utilizing price stops more with those options because the option behaves more like the stock. Low win rate equals consecutive losses. Just let me give you an example. Here in Vegas, when you play blackjack, something to know. Blackjack, you have about a 45% win rate, which is very similar to the 40% win rate we have option buying. Note on the left is your expected win rate. On the right is the number of consecutive losses in a row over a 50-trade period and the probability of those losses occurring. So one of the bolds I have is that over a 50-trade period and a 40% win rate, you have roughly a 63% chance of seeing 6 losing trades in a row. Say blackjack's a 45% win rate. You have a 70% chance of seeing 5 losing hands in a row. Why do I tell you that? I tell you that especially from an option trader, and you're subscribing to an expert like Bernie Schaeffer, who's been doing this for years. Even us who've been doing this successfully for years, with our 40% win rate, you could see 6 losing trades in a row. I think a knee-jerk reaction to someone that just bought a option trading service from an expert like Bernie Schaeffer might think, okay, I just received my 3rd losing trade in a row. No way will this expert be wrong 4 times in a row. So I'm going to put a bunch of money in this next trade. Well, what if that trade's a loser? And there's a good chance it will be. Well, now your account has gone down considerably more than it needed to, just because you didn't understand the probabilities with respect to how win rates and the potential of consecutive losses. So this is a very important table and something that I would recommend that you have with anything you do that has when you can anticipate what your win rate might be, so you can determine what your probability is of seeing a number of consecutive losses. Even if you're playing heads tails, a 50% win rate, you have a 30% probability of seeing 6 losing tosses in a row. And you have to keep this concept in mind. Your average win, given a certain win rate, your average win has to be higher than your average loss. You can have your next door neighbor could have a higher win rate than you, but be losing money. And this table shows you how. In order to determine the return on $1 invested, you take your win rate and multiply it by your average win. And then you subtract your loss rate by your average loss. So notice, if one has a 40% win rate, but his average win, because he's letting profits run, is 80%, and that means he has a 60% loss rate, but he's out there cutting losses, and let's say it's at 35%, his return on $1 is 11%. He's getting 11 cents for every $1 invested. Now, his next door neighbor could brag and say, hey, I got a higher win rate than you. Why has he got a higher win rate? Well, every time he has a profit, he takes it. But he's also probably holding losers, hoping they turn around and book that as a winner. And because he's doing that, he probably has a higher average loss. So if you have a 60% win rate and you're cutting your win short, and your average win's only 30%, your loss rate's 40%, but you have a big average loss because you're always hoping things turn around, now you've got a 6% loss. So even though you have a higher win rate If your average win to average loss ratio is upside down, you can lose money. And remember this, you've got to allocate more to in-the-money options and at-the-money options. And this table shows you why. Again, like the table I showed you before, it takes you through different scenarios, this time comparing a short-term in-the-money option versus an at-the-money option. It shows you how you can invest less in the more aggressive at-the-money option and still yield profits even more than the in-the-money option buyer. But it also can show you how you can lose 100% of your dollars invested and why you don't want to put as much money in those type trades. So this is a slide to focus on in terms of why you put more money into in-the-money options than you do at-the-money options, especially when they're short-term. Common mistakes I see: mismatching expiration date with the trade drivers. In other words, if I'm looking for a sentiment unwind and I want it to be broker upgrades, I don't want to buy next week. Those upgrades may not come in the next week. It may take a few months to play out. Another mistake is constantly overpaying for your option. Again, we are well in tune with the implied volatility relative to the implied volatility over the past year and relative to the historical volatility of the underlying. If you're constantly paying high implied volatility, you're more susceptible to the time decay and it reduces your potential reward. Trading without an edge, as I said before, we absolutely have to have at least two trade drivers of multiple trade drivers that we know few or no one else knows about. Allocating too much money to a trade. The next trade has to be profitable mentality. Think back to the consecutive loss table. And buying equal contracts despite options having different risk-reward characteristics. What I'm saying there is don't put the same amount of money in a at-the-money option than you do in the money options. Totally different risk-reward profiles. Another mistake, taking profit quickly is just so you can have a win. And then also you hoping losing trades return to profitability. Another mistake, buying the cheapest options, the 25-cent option versus the $2 option. Yes, the $2 option may be more expensive, but it may behave more like the stock, and it may not be made up of entirely time value. Thank you for your time today, finding out more about our Elite Trader trading program. Remember, 100 to 200% targets. We do email delivery and text alerts, and we also give you commentary as to why we recommended a particular option. Thank you again.